Something extraordinary just happened in the UK property market, and most people missed it because it wasn't announced with flashing headlines or emergency press conferences. Instead, it slipped out quietly, almost casually, during what looked like a routine media appearance. The CEO of Rightmove admitted that properties aren't just failing to sell anymore. They're being erased. Not reduced, not withdrawn. Deleted entirely after sitting unsold for roughly 300 days because, in his own words, they were damaging market confidence. Since October alone, 147,000 homes have vanished from the UK's largest property platform, a number bigger than the entire housing stock of Birmingham, and that revelation should make anyone paying attention stop cold. When markets are healthy, prices adjust. When markets are unstable, sellers hesitate. But when markets are breaking, listings don't drop. They disappear. And that single detail changes everything, because it signals something far more serious than a slowdown. It signals a coordinated effort to control perception while the foundations quietly crack underneath. And once you start following the trail of what industry leaders are now admitting behind closed doors, it becomes clear this isn't a correction. It's the moment the story finally breaks into the open. The deletion of listings is not a technical adjustment or a harmless housekeeping decision. It's a psychological intervention, and that's what makes it so alarming. In previous downturns, homes lingered on the market with price cuts stacked on top of price cuts, creating visible evidence that demand was weakening. This time, that evidence is being quietly removed. By deleting listings instead of reducing prices, platforms preserve the illusion that values remain intact, even as transactions collapse behind the scenes. It's the difference between seeing a car crash and being told the road is clear while debris is swept away overnight. Those 147,000 vanished properties didn't suddenly sell. They didn't find buyers. They simply failed in silence. And that silence matters, because markets don't crash when people see falling prices. They crash when confidence evaporates all at once. By hiding unsold inventory, the system delays that moment, but it also makes it more violent when it finally arrives. And this tactic only makes sense if the people running the platforms already know that visible price discovery would trigger something far bigger than discomfort. It would trigger panic. But the listings are hidden on the surface. Beneath them sits a much more dangerous problem. One tied not to sellers, but to millions of homeowners who already crossed a financial line they can't come back from. What truly changes the tone of this story is what surfaced next. Because while unsold homes can be hidden, mortgage math cannot. Nationwide's chief economist confirmed that roughly 43% of UK mortgages originated in 2022 are already in negative equity, meaning nearly half of those buyers owe more than their homes are worth. And 2022 wasn't an average year. It was the single largest year for mortgage origination in British history, with around 600,000 loans issued at peak prices, peak optimism, and historically low rates that no longer exist. This isn't a fringe issue affecting reckless buyers on the margins. It's hundreds of thousands of households who did exactly what the system encouraged them to do, only to discover that the ground shifted almost immediately beneath them. High loan-to-value products, 5% deposits, shared ownership schemes, all of it magnified the risk in ways that weren't obvious when prices only moved in one direction. A 1 or 2% decline used to be noise. Now it traps people instantly. And unlike stock losses, negative equity isn't theoretical. It locks people in place. You can't sell, you can't refinance. You can't move for work or family reasons without writing a check you don't have. And this is why the story changes here, because when debt overtakes value at scale, the damage spreads beyond individuals and into the entire system. Away from national averages and carefully managed indices, the regional data tells a much harsher story. Aberdeen is down roughly 37% from peak values, Belfast close to 30%, Newcastle around 24%, and Manchester, once promoted as London's unstoppable alternative, is hovering near a 20% decline. These are not small corrections or temporary pullbacks. They represent hundreds of thousands of pounds erased from household balance sheets in places that were sold as safe bets just a few years ago. London's numbers are even more revealing, because official figures lag reality, while estate agents privately acknowledge that prime zones are already down by around 30%. The difference between this and U.S. housing crashes is crucial. Cities like Austin eventually stabilized because population growth created demand floors. The UK doesn't have that cushion. Net migration for British citizens is negative, with hundreds of thousands leaving each year, while incoming populations largely cannot participate in homeownership. When prices fall without organic demand waiting underneath, they don't bounce. They reset permanently lower. And as values slide across entire regions simultaneously, attention turns to the sector that should be stabilizing supply, but instead is quietly unraveling. For years, property executives repeated the same reassuring message. Prices might pause, but they would never meaningfully fall. That narrative collapsed almost overnight. Foxton's CEO publicly acknowledged that values could return to 2019 levels at a minimum, a statement that implies a drop of around 40% from peak pricing. Savills went further, warning institutional clients that the UK faces its most severe property adjustment since the 1990s crash, not 2008, when real terms losses exceeded 50%. And then came the most striking admission of all, from Persimmon's CEO, who stated plainly that houses can no longer be built profitably at current costs and achievable prices, effectively declaring that the core business model of UK house building has failed. These aren't online commentators or fringe analysts chasing clicks. These are the people whose compensation depends on confidence, whose job security relies on optimism, and whose silence has historically been part of the system's stability. When executives start speaking this way in public, it's not courage, it's legal positioning. It means they believe the outcome is already locked in and they need to show they warned shareholders before the damage fully surfaces. And once you understand that, the focus shifts from whether a crash will happen to how far it has already spread across the country. In previous downturns, builders responded by lowering prices to keep sales moving. This time, many can't. Roughly 41% of UK construction companies now operate with negative cash flow, meaning they're losing money simply by continuing to build, yet stopping would trigger loan defaults and covenant breaches. So they slow down instead. Developments that should have dozens of workers have only a handful. Construction stretches into slow motion, not because demand exists, but because completing unsellable homes would force losses to be realized immediately. Major firms are sitting on thousands of completed properties they can't shift, even after offering massive incentives, covering stamp duty, and bundling discounts that would have been unthinkable during the boom. Even more telling, large builders have stopped buying land altogether. That's not a short-term adjustment. Land buying signals belief in the future. When it stops, it reflects long-term pessimism. And the desperation has moved beyond discounts into structural concessions that quietly admit a much darker truth. For the first time in modern UK history, new build homes are trading below resale properties, a reversal that exposes how distorted the system has become. New houses are supposed to command a premium. When they don't, it signals that affordability has collapsed entirely. Builders unable to offer mortgage rate incentives like their U.S. counterparts due to banking restrictions have turned to rent-to-buy schemes that effectively admit buyers can't afford ownership now or anytime soon. These arrangements delay reality, but they don't fix it. They trap people into hybrid obligations that combine rent and debt exposure without true ownership security. And this distortion feeds directly into the widening psychological gap between sellers and buyers, a gap that has frozen transactions across the country. The average UK seller still believes their home is worth close to peak 2021 pricing, often with an added premium for sentiment and memory. Buyers, on the other hand, are pricing properties closer to 2019 levels, with additional discounts baked in for uncertainty. That gap between seller fantasy and buyer reality is why homes sit untouched for months and years. Estate agents, caught in the middle, often inflate valuations to secure listings, then spend months slowly dragging expectations back toward reality. But by the time that happens, buyers have moved on. In London alone, tracked sales show average listing prices around £800,000, eventually closing near £540,000 after nearly a year. Not because value changed overnight, but because acceptance arrived late. And that delay matters, because while sellers hesitate, an external force is approaching that will force decisions whether people are ready or not. Roughly 2 million UK mortgages are set to reset, moving from ultra-low fixed rates to today's vastly higher borrowing costs. Monthly payments that once sat comfortably around £1,100 are projected to jump toward £2,100 or more. And the most alarming detail is that around 2/3 of borrowers won't even qualify for refinancing under current affordability rules. That leaves them stuck as mortgage prisoners, pushed onto standard variable rates approaching 9%, where payments rise while debt grows. Banks won't rush to repossess, not out of kindness, but because mass repossessions would collapse values further. Instead, they'll offer forbearance, allowing interest to accumulate quietly. This creates a slow, grinding financial suffocation rather than a sudden break, and it's happening inside a country where long-term fixed mortgages barely exist. Every loan is a ticking clock. And as property wealth evaporates, pensions mark down, international capital exits, and governments run out of tools, the truth becomes unavoidable. The UK didn't just overbuild homes. It overbuilt belief in a system that required prices to rise forever. That belief is now dissolving not slowly but faster with each quarter, and once collective denial gives way to acceptance, the shift won't be gradual. It will be sudden.